Everyone says QQQ is the ultimate growth ETF, but what if I told you that choosing it over the wrong ETF could have quietly cost you thousands of dollars over the last decade? Most investors chase the highest past returns, but that's the wrong question. The real question is why these ETFs perform differently. Let's compare three of America's most popular growth ETFs, QQQM, VGT, and SCHG. If you want maximum technology exposure, VGT is almost entirely invested in the tech sector, which helped it deliver incredible returns during the AI and cloud computing boom. But that also means if technology struggles, your portfolio feels the full impact. QQQM takes a more balanced approach by tracking the NASDAQ 100, giving you exposure to the biggest innovative companies across multiple growth sectors while charging a lower fee than QQQ. Then there's SCHG, the quiet low-cost powerhouse. It owns hundreds of large-cap growth companies across multiple sectors, offers broader diversification, and has one of the lowest expense ratios available. Those tiny fees may seem insignificant today, but over 20 or 30 years, they can compound into thousands of extra dollars staying in your portfolio instead of leaving it. So, which ETF is actually the best? There isn't one universal winner. If you believe technology will continue dominating the next decade, VGT makes the strongest case. If you want a proven, diversified growth strategy backed by the NASDAQ 100, QQQM is a solid choice. And if you value low costs, broader diversification, and long-term consistency, SCHG deserves serious attention. The investors who build real wealth don't spend their lives searching for the perfect ETF. They choose a strategy they truly understand and stick with it through every market cycle. That's how long-term wealth is built.